The quarterly check landing in Jake's account feels like proof the portfolio is working. That feeling is the whole product, and it's exactly what makes dividend investing so hard to argue against. Not because the math supports it, but because the psychology does. Here's the problem. 2 Nobel Prize winners proved that dividends are mathematically irrelevant, and almost nobody in the dividend community wants to talk about it. Meet Jake and Marcus. Same age, same income, same goal. Retire with enough money that work becomes optional. Jake builds a portfolio of dividend stocks. Marcus buys a simple S&P 500 index fund. Jake gets quarterly checks. Marcus watches a number go up on a screen. For years, Jake thinks he's winning. And on paper, it kind of looks like he is. But there are at least 4 things happening inside Jake's portfolio that he has no idea about. And by the time we get to the last one,
It's going to completely reframe how you think about what passive income actually means. Here's what this video is going to do. Walk you through the real math, the real tax situation, and the real performance data behind both strategies, so you can make this choice based on facts instead of feelings. I've gone through the academic research, the historical return data, and the Nobel Prize-winning economics that most dividend content never mentions. So let's get into it. The second biggest thing Jake is getting wrong is the performance gap, and the numbers here are genuinely uncomfortable if you're in the dividend camp. The S&P 500 Dividend Aristocrats is a stock market index composed of companies in the S&P 500 that have increased their dividends in each of the past 25 consecutive years. That's the gold standard. These are the most disciplined, most reliable dividend payers on the planet. Companies like Coca-Cola, Johnson & Johnson, Procter & Gamble. And yet, the Dividend Aristocrats Index has slightly underperformed the broader market over the last decade, with a 9.53% total annual return for the Dividend Aristocrats and a 15.55% total annual return for the S&P 500. That's not a rounding error. That's a 6% annual gap compounding over a decade. The reason is pretty straightforward once you see it. Over most long-term periods, the Dividend Aristocrats delivered similar total returns to the S&P 500. But in recent years, they haven't kept up with the increasingly tech-heavy index, as investors have flocked to growth stocks and AI companies. The companies that didn't pay dividends, the Amazons, the Nvidias, the Alphabets, were compounding capital internally instead of mailing it out. That internal compounding showed up as price appreciation. Jake's portfolio missed most of it.
And there's a reason for that, which gets into something the academic research has documented, but dividend content almost never mentions. When a company consistently pays dividends, it's telling the market something. It's telling the market it cannot find internal uses for that capital that would generate higher returns than just returning it to shareholders. The dividend check is sometimes a concession, not a sign of strength. The fastest growing companies in history paid no dividends and plowed capital back into the business instead. So when Jake looks at that quarterly check and feels like he's winning, he might actually be holding companies that have quietly run out of better ideas. Now, here's the thing that keeps most people watching dividend content, and it's not performance, it's the feeling, the mailbox money feeling. The idea that real dollars are landing in your account without you having to work for it. That psychological comfort is real and it's powerful. But that same psychology has a mirror image that quietly hurts dividend investors: the dividend cut. When a company cuts its dividend, investors often panic sell, treating the cut as a signal of catastrophe, even when the underlying business is fine. Index investors don't face that trigger because their returns aren't structured as income events. The S&P 500 doesn't have a dividend to cut. There's an underrated behavioral durability to owning something
That doesn't send you a regular check and then occasionally stop. Jake has to manage his emotions around income events. Marcus just doesn't. But the performance gap and the psychology are actually not the most important things here. The most important thing is something 2 Nobel Prize winners figured out in 1961, and it changes the entire foundation of how dividend investing is sold to you. In 1961, economists Franco Modigliani and Merton Miller published a paper that became a cornerstone of modern finance. Their conclusion? In a rational market, a company's dividend policy has zero effect on its value or your wealth. When a stock pays a $1 dividend, its share price drops by exactly $1 on the ex-dividend date. You haven't gained anything. The money just moved from one pocket to another. The authors themselves called it obvious once you think about it. The entire dividend investing community is built on a psychological preference, not a mathematical edge.
Think about what that actually means. If you own a stock trading at $50 and it pays a $2 dividend, it opens the next morning at $48. The total value of your position is the same whether the dividend was paid or not. Chasing a 6% dividend yield on paper is not the same as earning 6%. You're receiving 6% of your own money back with a tax bill attached. And that tax bill is the part almost nobody explains correctly. Most dividend investors using a DRIP, a dividend reinvestment plan, assume they're deferring taxes since they're not taking cash. They're not. The IRS treats dividend reinvestment exactly the same as receiving cash. You owe federal income tax on every dollar of dividends in the year they're paid, regardless of whether that money was used to automatically purchase additional shares. You're paying taxes on money you never actually held in your hand. Marcus, in the same taxable account, doesn't face this forced annual tax event. His gains only get taxed when he chooses to sell. That's not a small difference. That's the difference between the government deciding when you owe taxes and you deciding when you owe taxes. Over 30 years, the compounding effect of that tax drag is enormous. And here's the part that ties all of this together, the thing I said I'd come back to at the beginning. Marcus can manufacture
His own dividends, and he can do it more tax efficiently than Jake. This concept is called a homemade dividend, and it comes directly from the Modigliani-Miller framework. Instead of waiting for a company to hand him income, Marcus sells a small portion of his index fund shares whenever he needs cash. The tax advantage is real. With a regular dividend, the entire amount is taxable. When Marcus sells shares, the tax is based only on his capital gain. So if he bought shares at $50 and they're now $60, he's only taxed on the $10 gain, not the full $60 proceeds. He also controls the timing entirely, which lets him sell in low-income years when his tax rate is lowest. Jake gets no such control. The dividend arrives on the company's schedule at whatever tax rate applies that year. Now, to be fair to the index fund side, it's not without its own blind spots, and this is the thing I want you to actually think about. Buying the whole market sounds like perfect diversification. But by the end of 2025, the 10 largest companies accounted for nearly 41% of the S&P 500's total weight, more than doubling in just 10 years. More than $40 of every $100 invested flows into just 10 companies, creating a feedback loop where passive inflows disproportionately support the largest stocks. The 500 companies framing is technically true and practically misleading. The effective number of companies driving returns is closer to 54, meaning the index behaves as if it held 54 equally weighted stocks, despite holding over 500. So Marcus isn't as diversified as he thinks. That's a real risk worth naming. But here's the difference. That concentration risk is a structural feature of the market itself, not a flaw in the strategy. If those 10 companies continue to dominate, and they've been doing so for over a decade, Marcus benefits. If they don't, Jake's portfolio isn't immune either, because those same companies make up a massive chunk of the broader economy. The honest answer to the title of this video is that both strategies have trade-offs, but the trade-offs are not equal. If you're in your 30s or 40s and your compounding runway is long, optimizing for income today through dividends is frequently sacrificing the compounding that would have made income irrelevant later. The dividend investor gets the feeling of financial progress every quarter. The index investor gets the math of financial progress every decade, and the math tends to win. Jake's quarterly checks feel like proof he's building something. And in a way, he is. But Marcus's boring number going up on a screen is quietly doing something Jake's portfolio can't. Compounding, without forced tax events, without the psychological trap of dividend cuts, and without the performance drag of companies that have stopped reinvesting in themselves. So which life do you want? The one that feels like it's working, or the one that actually is? If this changed how you think about dividend investing, even a little, drop a comment below. I want to know which side you were on before you watched this, and whether anything shifted. And if you want to go deeper on how index funds actually work under the hood, the mechanics most people never learn, that video is coming soon. It connects directly to everything we just covered. Thanks for tuning into MoneyPatch. Small steps, big change.